is investment in infrastructure to develop new assets and to manage them for 25 years. So we are quite far from the private equity model. And this has quite a consequence and an impact in the approach that our investors, through us, bring to the infrastructure market. It's about, in fact, the channeling of long-term resources to long-term assets to create long-term economy. And first of all, the equity side, because as been mentioned, the need for equity to be more present in this market. First of all, in infrastructure, I would say that infrastructure remains a business which is predominantly financed at a regional level by regional savings. Europe, likewise other main market in infrastructure, are based on the same principle and is mainly financed by regional savings from Europe for European infrastructure. So to a certain extent, from our standpoint, this kind of regional approach as opposed to national approach is very real. Equity is already around, investors are already around, so for us there is no investment union and no CMU without investors. And currently we consider quite a huge potential by unlisted infrastructure funds to intervene with equity. Unlisted infrastructure funds at the very beginning of 2015 are still managing quite a huge amount of what we call the dry powder, meaning capital ready to be invested and available. Europe, out of the overall approach, is around 25 billion of equity funding available for investment. New funds and new volumes of funding are available every year, and they're now reaching the same level back when compared to pre-financial crisis, covering the, would say, the full spectrum: brownfield, greenfield, new assets, current assets, development, more traditional private equity approach on the shorter term, meaning probably exit out of 8 to 10 years, and then, of course, supporting also our industrial partners as industrial developers. Now, what the investors are looking for when they invest in infrastructure. The narrative of infrastructure has been quite precisely defined by some studies by EDEC, which is the low price elasticity of demand, so the low correlation to the business cycle, which is very important. Monopoly power, which means pricing power and a natural hedge versus inflation. Predictable, contracted, stable cash flows. An adjusted and balanced and structured risk-return approach. And the opportunity to invest in unlisted assets as opposed to being in a market with a mark-to-market obligation. So all in all, what the infrastructure is offering investors, both for equity and debt, is an increased diversification in terms of asset classes, a better liability hedging, because institutional investors are people managing assets ranging from 20 to 40, 45, 50 years in terms of liability, and less volatility than capital market valuation. In other terms, you invest in an asset which is self-performing its own valuation when sticking to what we call the base case, more or less, meaning what the predictable development of the asset is over time, is less exposed to what you can call a market valuation, which is typical of private equity instead. Now, coming to the spend to lend dynamic, what we think is that, I mean, like as investors from the equity side, we use quite a number of financing solutions. So we observe institutional investors coming to that, and we observe banks still being very a big traction in this market. What we see is that when compared to the pre-financial crisis years, institutional investors in that are coming in quite a number and for huge volumes. We had a ratio 1 to 10 in 2007 between project bonds versus loans by banks. Now we are in a ratio of 1 to 3.5. So this is increasing. So everything should be fine. But in fact, we are not completely convinced that this is fine, because what we see when we invest in the States, this is quite a clear, I would say, task sharing between banks and capital markets, where banks do a lot of things, but until a certain tenor, and capital markets do the rest. And there is no question about, are investors sufficiently clever to understand an infrastructure? Because they are. They are not structurally more stupid than any guy around. So the point is that what is happening in Europe is a quite different situation, because if we take the number of active MLAs in the project finance arena, we discover that they are even more active and even more numerous than they used to be pre-financial crisis. While in the American arena and in the Asian arena, the number is decreasing. So what's happening, in fact? Banks are, I'm not diplomatic, challenging investors, bringing a race which is a cheap financing which is acting negatively from our standpoint on both sides of the risk-return equation, because cheap pricing should be fine for developers, but cheap pricing is pushing investors back from the debt arena. And many banks are betting that they will be able to get rid of these assets by originating to distributing, which is false, because if investors are not coming at the very primary issuance of a debt, they will not come after on the secondary market. And which is much more worrying from our standpoint is that they are acting on the structure of the long-term financing by depressing the covenants to be more attractive, to be more competitive. And this is something for us as equity which is very worrying, because it's not only cheap financing with cheap remuneration of the equity, but it's also very volatile structures impacting the viability of a long-term investment, because you cannot really plan to stay with an asset playing around a few basis points in terms of flexibility in a structure and say, it's everything goes well, it's well, but if even the tiniest thing is going wrong, this is going to get wrong. Now, from our standpoint, what we don't understand is that banks are still under Basel III and probably about to undertake Basel IV regulations. They are increasingly focusing on RWA situations, LGD situations. I don't know what kind of panel of relevant transactions they are using to calculate their return when they are issuing pricing that are now getting almost back to the most liquid years around 2006. But we don't think it's natural either for commercial banks to go and finance assets for 32 or 31 or 35 years. And we see that again now. And this is pushing investors back. And the point is that we are at a critical situation where the investors are clearly not trying to push the battle until the very end, because they consider this is not good for their portfolios. So it's a situation where we would recommend the different players to probably find a more balanced harmonization between what the areas where specialized banks and investment banks can bring support and facilitate the disclosure of new long-term funding solutions, as opposed just to feed a, I would say, tactic competition, which is destroying value, I think, for all players around, for all actors and all parties, inclusive the grantors, the public sector, because in the end, an asset which is performing not correctly is an asset that will sooner or later be back on the public side.